In that example, we talked about buyers and sellers, remembering that with our strategy, we're sellers of options. So we're first and foremost, we're selling options and we're selling option credit spreads. So we're going to get a little bit more into that now and talk about our strategy. So sellers of options, they do very well because they collect regular premium, as you saw with the gentleman who owned the house. They collect regular premium during sideways or trending markets, and they also take advantage of a thing called volatility. Now, volatility is how options are priced, or one of the components of pricing options. So, the more volatile the market is, the greater the risk for those people selling options. Now, if there's a greater risk, there's obviously going to be a greater premium. So, if you are selling options during volatile conditions, then you'll get a much bigger premium. So, I guess you might say, well, if we're sellers of options and our strategy is to sell credit spreads, so we're taking in premium, wouldn't that be potentially risky or have an increased risk during periods of volatility, and particularly periods of extreme volatility that we experienced starting in 2007 with that fairly savage bear market? And so option strategies vary from very commonly traded by institutional traders to hedge their portfolio. So we've got buyers and sellers of options. Remember that buying is difficult because you're speculating on direction, and you have to be right on price as well. Whereas option sellers have an edge because they're utilizing a thing called time decay, which is basically every option has a specific time value, and as soon as you sell those options in the market, the time starts to erode on those options. So they lose value at an increasing rate as they get closer to their expiry date. So remember that according to the CME, 75% of all options expire worthless. So really selling gives us an advantage, a clear advantage in the marketplace. So 75% is a very, very good trading edge. Now, we're going to come back to the question of volatility and extreme volatility, because obviously selling is where the edge is, but that edge is diminished when there's periods of extreme volatility. I'm going to take you through our strategy now. So this is the key equity hedge. So our strategy really is based around the concept of selling options and using futures as a hedge. So rather than using options to hedge, say, a portfolio of stock, we're actually using the options to sell in the market, because we know we've got a 75% strike rate if we sell options in the market. And the way we protect those spreads is we use a futures hedge, and we're going to take you through that now. So the idea is that we want to protect our option positions. We want to take advantage of increased premiums during volatile markets, and we talked about that before. What generally happens is option spread traders do really, really well for a long period of time when the market is range bound or in a slight trend. But when it gets very volatile, which is when the premium's at its highest, that's when option traders really struggle. So with this strategy, you'll be able to take advantage of obviously that greater win rate, but also take advantage of those volatile markets or volatile times that we've had just recently. And with this strategy, we're not looking to try to be right on price or time. So we're not trying to time the market. They're non-directional trades. We're looking to smooth our equity curve and just bring in a nice consistent return. And the other great thing about this strategy, which we'll go into a little bit more detail here in a minute, is that the strategy combined with the options combined with futures, it actually has a margin offsetting effect. So what that effectively does is it helps us to reduce our margin, which is one of the toughest things when you're trading option spreads, is obviously your potential exposure to margin. Go through how we select our spreads. Alright, so what we're looking for initially is what we call a delta, and we're looking for a delta of between 5 and 12. Now, as you'll know from our introductory video, options have a number of components that make up their pricing. Obviously, delta is one of those, and I'll just give you a quick definition of the delta. Now, remembering that the delta of an option is the sensitivity of an option price relative to the changes in price of the underlying asset. So it really tells the option trader how fast the price of an option will change, as the underlying stock of futures or index move. It is also described as the probability of a particular option expiring in the money. So if we've, say for example, got an option with a delta of 5, that basically in layman's terms is referring to the percentage probability of that option expiring in the money. So that's got about a 5% chance, and we say if we've got a delta of 12, it's got about a 12% chance. So really we're looking for option spreads with a low delta because we want our options to have a low chance, less than 90% chance of expiring in the money. Because remember that if we set our spreads and the market stays within the boundary of our spreads, then we get to keep our premium. If the market moves and hits our strike prices, then that's where obviously we'll be giving up our premium. So we'll go into a little bit more detail here shortly, but as we know, our strategy requires a delta of between 5 and 12. That's what we're looking for our spread. Our risk tolerance is also the days to expiry. So we're not looking to trade any more than 70 days to expiry. Alright, so key equity hedge summary. Very simple. We sell short-term options to collect premium and trade the futures market using our hedge line and profit taker strategy to protect the option position. So we're selling spreads short-term and we're hedging it with our futures. So we hold options till expiry while trading the underlying futures market to protect and make profit. So that's the cornerstone to our strategy. We've got a proprietary futures indicator that we use to tells us when to get in and when to get out of the market. So we're going to take you through now a very clean example of how that system looks.